Some people just created a new LLC and they put some startup money into the bank account. Then they used some of that money to pay off the debts of an LLC that they used to own. Can they do that? And how do you do the accounting for that? Super question. What I often encounter is serial entrepreneurs, and things can get chaotic, things can appear to be complex. But if you break down each situation and look at it step by step, you can see it with clarity, simplicity, and then have the way forward. So the answer is yes, they can do that. And how to record it depends on what they're doing with that in reality. And here's what I mean by that. The old LLC and the new LLC have nothing to do with each other. The new LLC did not purchase the old LLC. It's just that a group of people closed one company and opened another. So therefore, we're not looking at this as an M&A, a mergers and acquisitions. We're not looking at this as an M&A event. Treat them as simple and separate units. Some owners opened up a new LLC. Now, what happens in the old LLC is really irrelevant. And on some level, it was rather inappropriate, or at the very least irrelevant, to use the money from the new LLC to pay off the debts of the old one. So now here's where you can choose option A or option B. Option A, if you're going to pay back the new LLC to restore that money, then when the new LLC pays those debts that are really unrelated, you can record that as a loan receivable from the owners. That's an asset, and you're going to want to pay that back fairly quickly. And I'll tell you more why about that in a moment. However, if you don't plan on paying that back to the new LLC and restoring those funds, it just reduces equity. You put, let's say, $100,000 into a business to start her up, but you paid out $25,000 for something unrelated. In other words, you're saying, oops, that $25,000 shouldn't have gone into the business in the first place. We're using it for something totally separate, so you reduce equity. No income effect, no loans, no expense effect, no income tax effect. It's just, oh, we invested too much. We needed some of that for something else. So you backpedal on that. And for my debit and credit friends out there, that's a credit cash, debit equity. Now, here's where it gets a little bit more juicy. If you think of it as a note receivable, you want to show it as an asset, you want to keep your equity at $100,000 for whatever reason, you're going to have to pay that back. And here's why. If you don't intend on paying it back, but you record it as an asset, as a note receivable on the books of the new LLC, it's misleading to anyone who reads it. And it doesn't really show the substance of the transaction. So you have to consider who's reading your financials. But it goes a step further. If any company could loan money to anybody else for any reason, and then later decide, you know what, I'm not really ever going to get this back, let's write it off. That means that any company anywhere could get a tax deduction. That's the write-off when you say, I'm not getting this note paid back. They can get a tax deduction for lending money to anybody from whom they never expect a return payment. That doesn't make any sense, and that would never fly. And upon audit, any IRS agent would never believe for a second that it was actually a note. So if it really is a note, have a loan document drawn up reflecting your intent and the actual terms that you're creating in reality. Have that reflected in a document with an amortization schedule and a loan repayment schedule and a realized interest rate. And then actually start to have that note repaid. Then it's more believable that it actually is a note receivable. Great question. Thanks so much for writing in. And I want to really highlight the underlying principle here. What may seem to be a complex situation can become clear and simple when you really break it down. Compare the parts and pieces of a situation with the reality, and then make sure that reality gets expressed in your accounting records. So people who count on those records to make decisions, like investors, banks, they're looking at the story. They're looking at the real story of your organization and what's happening.